My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey gang, welcome back. Today our special guest zooming in from Iowa is a very, very experienced real estate entrepreneur. Ryan Webster got started as a home builder, and then he made the transition into becoming a multifamily syndicator. He didn't waste any time. Ryan, correct me if I'm wrong, but I think you got 17 units in the or 700 units in the portfolio in like your first year or two or something crazy like that.
Yeah, we definitely hit the ground running. We in the first 12 months or so, we hit a little over 700 units and just shy of $100 million, worth of the portfolio. Nice. And then things slowed down a little bit, but, spent the last 5 years or so building a portfolio worth over 200 million.
Very nice. So give us a little snapshot of the portfolio today, we're almost at the end of 2025. How many properties or communities do you have in the portfolio? Kind of what's your unit count? And maybe tell us a little bit about the markets and the buy box that you have.
Yeah, absolutely. And things have kind of changed in terms of the buy box over time.
Okay.
But yeah, we're down to just 4 properties now. Still over 1,000 units. I think we're sitting just over 1,300 units right now.
So pretty large properties. Yeah.
Yep.
These are big ones. Okay.
And then that was part of the buy box from the beginning, was focusing on, larger complexes over 100 units, mainly due to the management constraints. So when I first started looking into, multifamily as an investment, I looked around locally, where I live here, and it's a pretty small market in the Midwest. So in terms of investability to attract, capital from investors, it just wasn't a market that was going to do it.
Okay.
So then we go, well, where do we want to invest? Initially we had targeted Florida at the time, looked to be a pretty investable place. But you need larger scale if you're going to buy things and manage things at distance like that.
Okay. So that's why you decided to take down the big one. So right now you've got 4 properties in the portfolio. Are they all in Florida still, or have you branched out to other areas?
All in Florida, mostly Gulf Coast. Then we've got one over on the East Coast.
Okay. Very good. So larger properties, are you looking at fixer-uppers, or do you want them pretty pristine when you get them?
Yeah, the buy box in terms of the condition of the property hasn't really changed. The vintage has shifted a little bit as things have progressed, but generally looking for that value add, given my background in construction as a home builder, having the opportunity to improve the property through renovations, and then taking care of the deferred maintenance that starts to build up on these properties, owner after owner after owner, was a place that, we had an opportunity, given my experience and relationships with vendors and contractors, where we could get things at a slightly lower cost than, other investors bidding on the property.
Okay, that makes sense. So Ryan, you hit the ground running really quickly your first year in business. Were you one of those lucky guys born with that big old silver spoon in the mouth, or where did you come up with all the cash to buy all those doors year one?
Yeah, no, wasn't born with the silver spoon, and definitely went to the school of hard knocks on most everything, and continue to attend. But yeah,
you and me both, brother.
Yes. But raising outside funds from a combination of institutional investors and retail investors, into the syndication structure.
So how did you get the attention of institutional investors in your first year? Like most people, they have to do a few syndications before the big guys will even pay any attention to them. What was your secret to getting their attention that early?
One, it was a different time. So we started in post-COVID 2020 where if you had a picture of a multifamily property on the back of a sticky note, you could raise capital to it.
Yeah.
Now, that being said, we did tend to source more quality deals. We're very stringent on the markets, the locations that we were looking at, and then very thorough in the business plan we were putting together, the data we had to back it, and our focus in operations to execute it. So in that sense, there was a lot of capital chasing deals. We had the better quality deals, but we still had the reliance on our capital markets broker to put in the good word and push these institutional investors our way. That being said, our first deal, we had $14 million of institutional capital come in through a REIT, and it was about 14 months later, we were able to refinance that deal. We almost paid them off in that refinance, which our broker later told us that it's unheard of that anybody pay off an institutional preferred equity partner.
Mm-hmm.
A year after that, we pulled a supplemental loan and ended up paying them completely off. They're out of the deal, and we were able to return about 28% of our LP investor capital in that transaction.
Okay, good. So you got rid of the institutional there. Very, very cool. Okay, that explains it. Now it's been a little topsy-turvy in the multifamily space for the last couple of years, and you guys got in kind of when things were in a bit of a frenzy. Sounds like you were very smart about the properties that you picked, and it wasn't like the feeding frenzy of FOMO that everybody else seemed to have. You guys were really focused on good quality deals that had lots of upside. And I know when you were kind of filling out the information prior to our call, you talked about the difference that you've seen as running a real estate syndication business versus some of the other businesses you've been involved in, especially since all of this happened. Can you kind of talk to that a little bit, Ryan?
Yeah. Let's back up on the point of the FOMO. So, we were sourcing quality deals. We were making investment decisions, backed in data to the best of our abilities. But because, most of these larger deals are transacted in a brokered and bid environment, you're not immune to the effects of this FOMO, because you've got to bid against the guys out there that are just chasing deals, throwing capital at that maybe have no business chasing the price up to the basis that they ultimate trade at. Mm-hmm. So from that standpoint, it becomes a difficult environment to make the investment, acquire the deal, and do it sensibly, because you still have to be the highest bid. So you spend a lot of time spinning your wheels and trying to avoid that investment thesis of this FOMO, and you have to own the deal. The other part of it is I had somewhat of a misconception of running, a multifamily rental business in comparison to more conventional businesses that, I came from and was used to running. I had this idea that the investment was, strictly and exclusively speaking, the business. You drive operations, you drive the growth of, the business, you drive revenue, you cut expenses, and you ultimately have a successful investment. That is a component of it. But because you have this institutional space, a lot of capital from a lot of different sources, you have this capital cycle and debt cycle that plays into the ultimate value of the property and the success of your investment. And so you can run a really solid business and grow revenue, grow NOI. That doesn't necessarily mean it's going to translate to a positive investment, because you have these two cycles. You have the real estate cycle, which is based on demand and supply, and demand, mostly through population, drives the upswing of that cycle, and supply drives the downswing of the cycle. And then you have this capital markets cycle, and it becomes this question of relative yield. You've grown this business, this asset that generates this net income, but the capital market determines the value of that net income. And that's what we saw, in the wake of COVID, when interest rates started coming up and the Fed started to unwind everything that they did with the quantitative easing. capital conditions got very tight, and you had situations, and we got caught up in a lot of this, as a lot of other people did, where you grew NOI. You may have even hit your business plan or exceeded it, but you still can't exit at the valuation you wanted to because the capital cycle was at a very constrained point.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Yeah, so nobody's going to loan on that building, or it's going to be very difficult for the next person to get financing to purchase that building from you. Is that kind of...
Yeah, or even not difficult. It's just the leverage point is much lower. Your next buyer is going to go lower leverage because rates have come up. The cost of that base chunk of capital is higher. So the relative yield for the LP investor is now smaller. So they're gonna bid lower because they're all chasing, a set IRR in their buy box. So then it comes down to real estate always has been, always will be a long-term investment. Can you have some wins on a short-term play, a fix and flip, development deals? Yes, but there's a risk that come with that. If you miss the timing, you're screwed.
Yeah. No, I hear what you're saying. And I think a lot of people got caught up in that short-term vision of multifamily.
Yep.
Because it was just churn and get out and double your money in 2 or 3 years. And people started to think that was normal when it definitely isn't. And then you've got the conflicting view, right, that a multifamily property is a business in and unto itself. And that we have control over the value of the business, just like you're talking about. If you increase the net operating income, that theoretically should increase the value of the property, but it doesn't really take into account the cost of money, right? So those capital markets that you're talking about. So it sounds like, you've got a much more holistic view of how the business really runs at this point.
Yeah, and the other interesting point is, and a lot of people don't realize this, and this relates more closely to the multifamily market, a little bit in the single family rental space, but in terms of your pricing power and where you can price rents, you have almost no control over that.
Right.
It's an entirely commoditized business. So what you can charge is really relative to the supply of units in that market, and it's going to go up and down relative to how much vacancy there is in the market. And you can, want to charge a premium on your value add units as much as you want to, but that doesn't mean the market's going to bear it.
Doesn't always translate.
Yep.
Yeah. I hear you. Oh, very, very interesting, Ryan. So with all of that in mind, where do you and your partner see yourselves taking your business over the next couple of years? What are you looking to accomplish and do?
Yeah, so that's kind of the interesting part. I think most people in multifamily space are in right now is we have this environment where rates are coming down, treasuries are starting to follow the Fed funds rates. You have unemployment starting to grow, which is going to continue to drive rates down. So the financeability of these deals is coming in. Equity is returning to the market. You're getting more liquid capital. But in terms of your near-term rent growth, in the wake of COVID, the other piece that we had is we had this kind of black swan event where a bunch of people moved, and that spiked demand. And the demand was very elastic. It happened very quick, and it drove rents very high because you get slammed with all this demand. It takes 2 to 3 years to build the supply to meet that demand.
Mm-hmm.
Well, we're 2 to 3 years later, and then some. That supply has now came and met that demand. And given the financing environment, we probably have a lot more supply than what we needed because developers were chasing this demand, chasing the run up in rents. They could finance anything because rates were low. So we have all of this supply in these very once hot markets. So the question is, okay, we now have rates coming down. We could finance these deals. We have the equity to buy them. What's the rent growth over the next 2 years? Well, I don't really know because we have all this supply of heavily concessed markets. Rents have come down over the last 2 years. So where's the tipping point and the equilibrium of when rents grow? And everybody's trying to look at the data and peg, I think it's 12 months out. I think it's 18, 24 months out. Right. It's a very hard equation to balance and get it right. And then we have this pending economic decline. Unemployment's continuing to go up. And the interesting thing, and we're seeing this on our owned assets, is when residents would leave a property, we get a notice to vacate. And the number one reason for notice to vacate used to be they bought a home. In the last 8 months, we're seeing more of, I lost my job. I'm moving for a job. I got laid off. I'm moving in with a roommate. Financial issues. Which continue to press on that this, this economic decline is very real. The question is, how long does it last? Is it short term or longer term? And that's going to, in the short term, is going to impact things. Rent growth is going to be depressed. In the long term, unfortunately, what you have is people will start to lose their homes. A lot of people are locked into cheap rates right now. But if you have zero income, you lost your job, it doesn't matter how cheap your mortgage is. Your savings can only sustain you so long, and you're going to have to sell that home. And those people will become renters. We'll get a push of demand back into the rental market, which will then drive some rental growth again. So we're in an environment where trying to peg the timing of when this growth kicks off again is difficult, even though the capital to purchase the assets is there.
Well, and the other side would be, are you starting to see prices dropping on these properties as well? Because everything was in a frenzy for a few years. There was out to lunch on what, as you said, on what you had to bid to be able to buy one of these properties. Now it's kind of getting a little bit back to normal. It's not quite so crazy there. So yeah, potentially some opportunities there.
And I think there are opportunities in aggregate, and most of the hot markets, prices have dropped in excess of 30%. Which is almost in line with what happened in 2008, which would stand to reason that these are pretty good discounts right now. But then you try to put into context, well, it's cheaper than it was. Is it cheap enough knowing that, my rent growth may be negative for the next 2 years?
Right. It's cheaper than what it was, but it was stupid before, right?
So is it cheap enough now is a hard question to answer. But then
is it a fair price now is the big question. Yeah.
So you come back to this long-term investment thesis, and you got to stop trying to nail the near-term timing, because the chances of you getting that right are pretty slim.
So what are you looking at now for your hold periods these days, Ryan?
I think it should be looking at a 10-year hold.
Yeah.
And if you hit the timing, you can sell anytime before 10 years.
Exactly.
It doesn't preclude you from
your window instead of a 2 year.
From hitting a 5-year plan. Yeah. But if you're running a 5-year plan, you can't extend it to a 10-year plan. Right. And that's where a lot of people got pinched over the last couple of years in this short-term bridge debt. They hit their maturities, rates ran up on them, they couldn't get out of it, and these were total losses.
Yeah. So now with the whole, if I'm hearing you right, it's kind of like get into deals where you can kind of hopefully under-promise a bit and over-deliver for your investor partners, do the 10-year time frame, and if you can exit and hit your targets in 5 or 6 years or 7 years or 8 years, you look like a hero because you told them 10. So then the question, it would beg the question, do you have to do anything differently to attract? Is it a different kind of investor that you have to find to be your LPs in these kind of deals nowadays?
And that comes into, especially on the retail investment side, and coming through this post-COVID boom, we had the syndication industry was just, preaching this, 5 to 7 year, value add flip model. And the other thing that they were preaching is this cash flow and appreciation. And yes, you own a business that generates cash flow. That's true. Do the LPs see any of that cash flow? Maybe. How high are you levered? Because the lender gets, first claim on that cash flow. And so depending on your leverage strategy, if you're higher leverage, you get, appreciation. Yeah. You're not getting the cash flow. The lender's getting the cash flow, which is one of the benefits of real estate investing, is you could use leverage to control a large amount of real estate, which for me as a sponsor, is good. I can take a limited amount of funds and I can build a really large portfolio. But to the individual retail investor, that may or may not be a good thing depending on your investment strategy, because leverage always adds risk. You get pushed back in the capital stack. And there's two groups, broadly speaking, of people who invest. You either have a lot of money, more than you need, and your primary concern is preserve the capital and make a yield that's in excess of my cost or spending habits. Or you're trying to build the principal balance to get to that point, in which case you go make the higher risk things and you're trying to grow that principal chunk. But you really got to pick a strategy and know the type of investment that you're in, which strategy is that into. And most of these leveraged real estate investments, at the level that they're leveraged and how they're leveraged, they're not really protecting that principal balance as well as most retail investors think that they are.
Yeah.
And then you get into this argument of diversification. Well, okay, I'm going to take my money and I'm going to, buy into 15 leverage deals in a bunch of different markets. So you're diversified against the market pressures. So if the real estate cycle rolls over in one market, it's not affecting your other markets. You're not diversified against that capital market cycle we were talking about. And that took down every deal in every market over the last couple of years. So you need to be diversified not only geographically, but in how you invest the capital into the deals, where you're either up in this LP leverage position behind this debt, but you also should have some investments where you are the debt, where you're not leveraged at all. So you have that protection from the rollover of the capital cycle through this diversification of how your capital is placed and your geographic diversification into deals in different locations.
Yeah, well said. Ryan, we got to wrap things up here, my friend. But this was a fascinating conversation. Thanks for sharing your insights. If people want to connect with you, where should they go?
The best place is our website at equityyieldgroup.com. There you can kind of see what we're doing. Subscribe to our newsletter. You can schedule a call with myself or my partner. And we do quite a bit of talking with investors just about the fundamentals of real estate investing and where we think the market is today. We get quite a few calls just to have those discussions.
Sounds good. Ryan, thanks so much for being on the show. It's been great.
Yeah, thanks for having me.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.